It's the end of another trading week and it's certainly been eventful, with continued concerns over a Greece exit from the euro and building fears over Spain and its banking system. All eyes now turn to next week's data releases as traders eagerly anticipate the results of several central bank rate decisions as well as a crucial ECB meeting. Joining me on the phone now to talk us through the week ahead is Peter Dragicevich, an FX Economist at the Commonwealth Bank of Australia, Sydney. Peter, there's a lot of key data being released next week, all of which comes at a time of global market volatility. In your opinion, which release should Dukascopy viewers be paying most attention to?
We think one of the major focal points of the week will be Ben Bernanke, who testifies to the US Congress Joint Economics Committee. Bernanke will provide his outlook on the US economy. Now, we're expecting Bernanke to be somewhat dovish. He's likely to stress that the US economic recovery is moving ahead, albeit quite gradually. He's also likely to indicate that the unemployment rate, particularly the long-term unemployment rate, remains frustratingly high. So we expect him to leave the door open for more stimulus by the Fed. However, he'll likely put the caveat on that and say that's more likely to happen if the economic conditions in the US deteriorate. So our forecasts still do not have the Fed doing more policy stimulus. However, if things do turn south in the US economy, we would expect the Fed to be proactive and undertake further easing.
Australia has a lot of data coming out next week, including the first quarter GDP figures and the RBA rate decision on Tuesday, followed by employment data out on Wednesday. The Australian dollar US dollar plummeted this week off the back of weak retail sales figures as they contracted for the first time this year. Will this encourage the RBA to instigate monetary easing, do you think?
Well, the retail sales figures released this week declined, but we did have a very strong result the previous month, which was revised higher. So whilst the latest month's data was 4, overall the recent numbers have been quite solid. We have had some positive data come out recently in terms of the GDP print. The volumes data for retail trade were quite strong. We also had the capital expenditure data out, which showed that capital expenditure undertaken was quite strong. The GDP print next week is likely to improve on Q4 of last year, and it's also likely to be quite strong on an annual basis because in Q1 of last year we did have the weather effects dragging down the economy, so they're likely to come out of the calculations. So it should be a pretty good GDP print, but we do have a number of components still to be released which will give us a better guide, and they're not released until early next week. But in terms of the RBA, we think that the offshore events are likely to be in the front of the mind of the RBA board. We still don't expect the RBA to cut rates until August, but given the uncertainty in Europe, we think that the upcoming meetings before August are likely to be live meetings, and it wouldn't be overly surprising if the RBA was to come out and cut the cash rate by a further 25 basis points before August. But that being said, the RBA may look to wait on the sidelines for a while, at least until after the Greek elections, just in case they need to reserve some of their ammunition and stem off, obviously, the negative fallout from a bad outcome in Greece.
Wednesday is also a big day for the Eurozone with an ECB meeting and first quarter GDP figures. There's been some debate this week regarding 8 states, including Romania, and the ECB stating that they do not yet meet the criteria for joining the euro. Is this the correct move by the ECB, do you think? And can we expect further debate on this next week?
With regards to those particular countries, from our understanding is that the ECB noted that few of them, most of them, didn't meet all the criteria. So in regards to their track record on inflation, government finances, long-term interest rates and legal convergence. In our opinion, it's most likely prudent by the ECB. They're very stringent on their criteria. So we're not expecting too much debate on that issue at the ECB meeting this week. More likely debate will be around further policy stimulus, given the deterioration in a lot of the business surveys in Europe, particularly the PMI data, and obviously the building concerns in the peripheral countries. We're expecting the ECB to cut rates in early Q3 by 25 basis points, But given the unease going on at the moment, again, it wouldn't be surprising if the ECB does decide to cut rates next week or implement further monetary easy policies, measures such as further liquidity operations, and/or signal that they're willing to reactivate the securities market program.
Andrew Goodwin from the Ernst & Young Item Club told Dukascopy TV this week that he didn't hold out much hope for a change in policy from the Bank of England's rate decision next Thursday. Would you agree, or do you think that now is the time for them to intervene?
Again, our view with regards to the Bank of England is that they will undertake more asset purchases. Our forecasts have the Bank of England doing a further 75 billion worth of asset purchases, which would bring the total up to 400 billion. Now, it's a question of timing. The Bank of England has indicated that the upcoming month's data out of the UK is likely to be quite volatile, given the Queen's Jubilee celebrations and the Olympics. However, what's more likely to happen this particular meeting, we could see more members of the MPC vote in favour of monetary more stimulus. Several members were noted to have had a finely balanced decision last month. Since then, we've seen Europe take a bit of a downturn. We will get some more business survey data before the next meeting out of the UK, such as the manufacturing PMI data. We're expecting that to move below 50. Yesterday we had the credit data out of the UK and the money supply data, and again that was quite weak. So we think at this particular meeting it's more likely that one or two additional members of the MPC vote for further stimulus, and then in the coming months we think that the Bank of England is likely to undertake that further stimulus.
That's all we've got time for right now, but thanks to Peter for his insight. We'll be keeping you updated on all of these events, so stay tuned. For now though, goodbye.